Master your money, free your future. Welcome to Budget for Life. My name is Jeremy. I'm not a professional YouTuber. I am a financial advisor, but this video is not financial advice. In this video, I want to talk about another huge clue related to GameStop's graded card marketplace and implications for GameStop's inventory. And I want to talk about the rest of GameStop's balance sheet. How can we project it as it relates to their Q3 numbers? I want to continue diving into this together with you. Before I do so, thank you to everyone who has joined as a subscriber. I appreciate the views, the comments, the watch time, the shares. We've got less than 400 spots left in the Halo sub club. So if you forever, for all of time, want to have the clout of, hey, I was an early subscriber, I was a part of the Halo sub club, hey, all the way until 2525 subs, there's room for you. I'm hoping to cross it this calendar year, so we'd love for you to be a part of it. Also, thank you to the fans and the friends of the channel who go the extra mile. Okay, there's never any pressure to contribute anything financially to me or to this channel. All the earnings go to DRS Book GME shares. I don't live off of a single dime from this channel. But I do appreciate those who go the extra mile to support it and help the work get out there. Let's talk about the balance sheet, and then I'll talk about the graded cards clue. And I want to wrap up long-term assets and long-term liabilities. And we'll start with the liabilities because we know that the 4160, oh, sorry, this is August 2024. 2025, that 4160.9 of long-term debt, that is still going to be there. Okay, that is the convertible bonds, and GameStop's not even allowed to pay them back this early. So, as it relates to the long-term liabilities, all we're looking for is what do we project for operating lease liabilities and then other long-term liabilities. And for the operating lease liabilities, so the most recent number we had is 155.5 in Q2. The quarter before that, it was 167.8. So it came down about $12 million in long-term lease liabilities. The quarter before that, okay, the end of the year, it was at 249.5. So a huge drop from February 1st to May 1st. But most of that drop is related to putting Canada and France officially for sale, which moved the long-term portion of those liabilities to this like liabilities held for sale that joined the balance sheet later on. So all that to say, I would not expect another $100 million drop, but even quarter over quarter, even after you netted out the France and Canada stores being removed from the equation, you still had another $12 million drop quarter over quarter, which is basically the function of stores closing, right? Fewer long-term lease liabilities, aka fewer long-term leases, right? It's not that the value, the cost of the storefront is plummeting quarter over quarter. It's that the number of storefronts that they have is continuing to come down. So, how much of that do I think is going to come down this quarter? I think less. I think less than 12 million. I don't think it's going to go up. I don't think GameStop is um, interested in lengthening the terms of their leases. I don't think current leases are going to be lengthened. I think generally speaking, they're still on a trajectory of closing stores. I think they still have hundreds, if not more than 1,000 more stores left to close that they want to close. So I don't think it's going to go up. I think it will come down, but I don't think it's going to come down very much this quarter because I think they like to do most of their store count shredding in January, February, March, April. So January actually hits in Q4 because that's a part of their fiscal Q4, but a lot of it happens in Q1 and Q2. I don't think they're going to close a lot of stores in, August, September, October, right before the holiday ramp comes out. So that 155.5, I'm going to say that this quarter it's just at a 153. So we got 153 for long-term leases, and then you've got the other long-term liabilities. It was 18.4 at the end of the most recent quarter. 3 months before that, it was at 19.4, so it came down $1 million. 3 months before that, it was at 24.1. Again, that bigger jump, $5 million jump, probably related to Canada and France, but still another $1 million coming down quarter over quarter. I'm going to say that goes from 18.4, let's say 17.9. Let's say it's an entire $500,000 decline. So you have long-term liabilities overall coming down by another $3.4 million. Not very much quarter over quarter. And I think that's because they want to take advantage of the holiday sales. Also, if you look at Q2 to Q3 of last year, you saw a $3.3 million decline in long-term liabilities. And even the year before that, when they were closing stores even more aggressively, right? They had even more costs still to cut. You still only saw a $19 million decline. But I think this 3.3 is more accurate to what we'll see in this year as well. And this year I've got it at 3.4. So we'll see. Maybe I'm a little too aggressive. Maybe they'll have another $1 million and it's only 2.4. But I think we can know with pretty high clarity. So their total long-term liabilities is going to be basically their operating long-term liabilities plus their convertible debt liabilities. And then total liabilities is just going to be a function of these two put together. AH7 plus AH8. And this is how you would illustrate it if you were considering the convertibles as debt that will be paid back. And this is how you would illustrate it if you were considering the convertibles as dilutive and not something that will be paid back. You would just take their operating liabilities for a total of $1297. I feel like if I'm wrong on this projection, it's going to be that their accounts payable is actually a decent bit higher than what it is currently. But I actually have their current liabilities increasing already as it is, right, by about $30 million. The main reason that this 1297 is such a much lower number than the 1435 is because since then, France and Canada have been removed from the conversation, or at least Canada has already been officially removed. And then they've continued to close more US stores since then as well. All I'd say, if I'm wrong on the current assets, current liabilities, it's going to be related to them scaling inventory even faster in Q3 than we anticipated. And as a result, accounts payable scaling even faster during Q3. But I want to get into this clue in just a second because I think it solidifies, not solidifies, but adds a little bit more um, robust support for a inventory bump related to PowerPacks that is very mitigated, that's very cost calculated. I don't think you're going to see this number balloon to an insane level. And I'll get at that in just a minute. I want to talk about other long-term assets first. So you've got their Bitcoin, which I account for within their cash and securities. So I leave that out of this line here. I already put 51 for my expectation for PP&E, property, plant, and equipment. Then you've got operating lease, so long-term lease assets. You've got 249 as the most recent number. The quarter before that, operating lease right of use assets 272. So you saw a $22 million decline in operating lease right of use assets. And again, you'll probably see a bigger jump from Q1 to Q2. Yep, 374, because again, that includes France and Canada. Once you take that off the books, you still had a $22 million decline. How does that compare to the long-term lease decline? You had 167 and 155. So you had a $12 million decline on the long-term leases, and then um, current portion of leases went from 113 to 101. Okay, great. So if you're tracking with what I just showed you, I know it's a little hard to follow when I'm hopping 10Q to 10Q, but the lease assets is just one line item. But on the liabilities, it's split between the current portion of those lease liabilities and the long-term portion of those lease liabilities. And that jump 272 of lease assets down to 249, right? That 22 million was basically split evenly between current and long term. Now, what did I have for the current portion of the leases? It started the quarter at 101, and oh, I didn't actually split it exactly because I just based my current liabilities off of some portion of the inventory inflation. So let's think here. If they declined $12 million on the long term last quarter, but we're saying that they probably closed more stores in Q2 than they would in Q3. And so most of the stores that they held at the beginning of this quarter, I think they probably continued to hold, right? If they had a couple stores that were expiring, they probably let them go. Like they probably have at least a fewer stores now than they did before, but probably not as big of a decline as from 272 down to 249. It's probably not a $22 million decline. Maybe it is what do you think? $3 million decline? Let's call it a 3.9. That feels like a little aggressive. I'm going to call it just a 3. I'm going to say well, we'll round up. We'll call it 2.9 so that it can be an even 247 for the long-term assets, the long-term lease assets. Then you have deferred income taxes, went from most recently 18.8. Before that, it was 18.7. Before that, it was 18.1. So I'm going to say this number goes up again a little bit. We'll call it 19.1. Obviously, not a huge needle mover no matter what, so I'm not going to spend a lot of time talking about that. Then you have other non-current assets. So just other long-term assets, goodwill, etc., whatever they include in here. It went from 50.5 to 53.1, and then it was higher the quarter before that. Again, probably related to their stores, France and Canada, that were then listed for sale and moved to a different portion of the balance sheet. So, but it climbed other non-current assets. I wonder what I wonder like what all that includes. They probably don't really even say um, non-current assets recognized. Okay, long-term restricted cash. Oh, so it's like cash that is restricted. And then company owned life insurance. Okay, great. So they've got some life insurance now um, that they did not have before. Okay, and some of their assets held for sale. are also non-current. Okay. Management approved a plan to divest our operations in France. So that 177, they show you where that came from within the balance sheet. Like basically, this is how it would have been recorded before. Um, but this is where it's recorded now. It's just this single line item, asset held for sale. Right. And then the impairment cost. Okay. So all that to say, we can't really know that much about it as far as how much more will it have increased, but it seems like probably increased a little bit again. We'll just call it 54 and we'll see if I'm right or wrong. Long-term assets overall coming down a little bit. Stores coming down um, a little bit more aggressively, but some deferred assets, non-current assets increasing a little bit. Your total assets is going to be these three numbers put together. The Bitcoin number is going to be, where is Bitcoin? Bitcoin. 519 is going to be the Bitcoin number, 519.3. And then what is the cash number going to be? This one is kind of crazy because like the cash flow statement, this is where GameStop has the most variability. And also what's annoying about cash flow statements is they're always reported as cumulative. So you'll see like 3 months ended, right? So these cash statements are all based on what happened in Q1 of 2025, but their next quarter just shows you the 6 month ended. So this net income, you're like, wait, you had 213 million of net income in the second quarter, and then you look at it and you're like, no, you didn't. You had 179 million dollars in net income. You're like, oh, but if you add them together, oh, there's that 213.4, right? And so it's a it would be a good project for me. And at some point, I will have the capacity to line by line break down their cash flow statements historically, kind of similar to how I do with their balance sheet, but it will require not just logging each item, but taking this reported number and then subtracting the number from the previous 10Q, right? And then with Q3, again, like doing the same thing, like this is Q3 of last year. You'd have to net out the number reported on Q2. After their 10K comes out from last year, you'd have to net out the numbers from Q3 because they're all accumulating year over year. But the variables at play, we'll just look at this because it shows you one quarter. This is quarter one of 2025. Obviously, how much do they charge to depreciation can vary a decent amount. That's like a $5 million per quarter increase to cash, right? Because that's an expense that weighs against net income, but doesn't actually cost them any new money. So as far as what do you project their cash level to be, you'd basically say, well, what was the cash starting point? And then what did they earn last quarter, which they earned, I'm saying, or sorry, what did they earn during this quarter? 219.6 is my estimate. And then, which I think actually this estimate might be, I think they will beat this estimate. I think their margins might be a little bit higher than this. Um, Someone did make an argument that, hey, Switch 2 sales might actually be down quarter over quarter. And so maybe I'm overestimating the hardware. But you can go into my hardware projections video and share my where I share my rationale how I landed here. I also do think that their interest income will be slightly higher than this 91.7. Originally, I ended up with this 91.7, assuming that all of the cash that they're making is going to be reinvested into inventory. And so they're going to keep, I was basing this interest income off of the balance sheet of cash of 8694, right? 8.7 billion. But in reality, that cash level is ticking up by a few $1 million every day, hypothetically, right? They made this 219 million that bumped their total level of cash, and then they earned some interest on that cash. So if you were to take 220 million in cash, add in another 5 million for depreciation, 220 plus 5, it's $225 million cash difference, hypothetically. And then if you were to say that happened evenly throughout the quarter, which it doesn't actually work that way, but basically if you were to divide that by 90, then you'd say their cash increased by $2.5 million every day throughout quarter three, right? And so if you were to take the 2.9, or sorry, that 219 on a weighted average basis, if you were to say that basically the average meets in the middle, and so if you started out plus 2.5, you finished at 219. So for the average amount of time of the whole quarter, you averaged at just about half of 219, then you would say that really you had on average an average daily balance of about $112 million more. And what is, about 4% of that 112? That would get you about $4.5 million. But again, that's based on a 12-month 4%. So then you would divide that by 4 to give you just one quarter's worth of the average daily balance of new cash based on the interest rate that you're getting. And you end up with basically about 1.15 million more. So I'm going to say this 91.7 is going to a 92.8. Boom. Now, that increases this number, right? 220.7. But then what other adjustments happen here within a cash flow statement? So you have depreciation. You also have stock-based compensation. This seems to be relatively level. That, again, is a boost to cash, right? So on a quarterly basis, about a $5 million boost for depreciation, about a $5 million boost for stock-based compensation. These increase your cash level because they are expenses, right? They are SG&A that's taking away from your operating income, but they are SG&A that's similar to these convertibles. They're not paid with cash. In depreciation's expense, they've already been spent, right? That cash is already gone, so it's not affecting current cash levels. In stock-based compensation, it's being paid for with dilution. It's not being paid for with cash. And so these are bumps to your cash level. Then you're taking out the obviously the Bitcoin impact, right? So this total, which we've already done that, we've already adjusted for Bitcoin. But to help you understand that, again, in quarter three, their total net income was 168, but you wouldn't bump their cash level by that entire 168 because 28.6 of that came from a Bitcoin gain. So the 28.6, that would increase your Bitcoin amount, which I'm illustrating those as together. So it wouldn't make a difference for my spreadsheet, but um, GameStop differentiates, hey, the digital asset gain does not increase our cash, right? And then they took a little bit of a different, right, a super marginal difference there. Then you have asset impairments, right? 33.4 million that was recognized this year. Really a 35 million that then improved by 2 million. Not a huge swing, but as it relates to their cash flow statement, what they do with their French stores and how fast they close or sell other stores can have an impact. And then we have the operating assets and liabilities, which again might not all have been paid for with cash. So you have receivables that are um, money that you uh, earned that you haven't actually received yet. Then you have merchandise inventories. How much cash did you spend on inventory? Um, which can have a big swing, right? 82, like that's a $70 million swing quarter over quarter. And last year, you saw from Q1, right, $43 million difference, then to a positive 72, right? So that's then $110 million difference, then down to a negative 200. So that $270 million difference, right? And then for the full year, up to a positive 940. So then another $300 million difference. That's just reflecting the reality that, hey, they spend money on inventory in Q1 slash maybe some of Q2. In Q3, they're accumulating inventory, but they're not paying for it with money. They're just allowing accounts payable to accrue. But then in Q4 and Q1, they pay off that accounts payable with the earnings that they made from the sales of those products. So again, how exactly do you project that? It's tough. It's tough to say what that impact is ultimately on cash. And then again, the corresponding accounts payable. Basically, as long as these move together, which historically they do, it should have a marginal impact on how we project their cash. But overall, you have, hey, here's the total net cash flows from operating activities. You also have this long-term liability change, which again, most of that happened when they allocated France and Canada. But overall, you have net cash flows from operating activities, which is similar to the cash generated in income plus a few $1 million for depreciation and stock-based compensation. So I'm going to say adding in an extra $10 million there in cash, right? Expenses that weighed on the net income that weren't actually paid in cash. And then I'm assuming that the current assets were met with accounts payable and that they did not spend cash on that. We also don't know PowerPacks, right? How does that impact their cash flow? Then you have cash from investing activities. For all we know, they didn't change anything as far as raising new money, right? They have financing activities down here. And so you see like convertible debt issuances and then the cost related to raising those funds. We shouldn't see a swing there in Q3 because they didn't do any financing activities, except they did issue warrants, right? They issued a warrant dividend, which doesn't cost them any money. But what are the odds that some people already exercise their warrants, right? It's probably marginal, right? It's probably not a big impact. But if anyone exercised their warrants, that will raise GameStop's cash and slightly further dilute their float. But obviously, they would be paying $32 a share for a company that right now is going at $21 a share. I bet there are some people that have done that, but I don't think it's going to be a huge needle mover for their cash position. And so basically, we can kind of net out their financing activities and say, not a whole lot happening there. But then you have this huge, huge impact to their cash flow, which is how do they time the purchases and sales of their T-bills, right? They get money from the T-bill, right? If you buy a 1 month bill, then you get the money back after a month with the interest. But then do you roll all of that into the next T-bill, or do you hold some of it for a week before then putting it back in a T-bill, right? That changes the cash flow pretty substantially. And you'll see, like in quarter one, they redeem more, like they receive the proceeds, but they don't put it all back in to have that cash flow bump, which I think helps them weather the softer Q1 that every retailer experiences. But you'll see, like in Q2, they got 64 million more in proceeds, but then they deployed actually 67 million. So they got all the T-bills that expired during Q2. They reallocated all of it right away, and they weren't worried about the $3 million loss to net cash flow that creates because they have more operating cash flow within that quarter, and they raised another 4.2 billion in convertible debt, and so they weren't worried about that little spread. That spread in Q3 of last year, again, purchases versus proceeds, right? Huge proceeds, which most of that happened in Q2 of last year, probably. Or did it happen in Q1? Okay, a lot of it happened in Q1. Check that out. Like a lot of their government bills expiring without being reinvested right away happened in Q1, 200 million in proceeds, only 7.5 out the door. Huge cash flow bump, right? Q1 of 2024. And then in Q2, 270. So again, that net difference is another 70 million in proceeds without any more purchases, right? And then no proceeds during Q3, but they do purchase 30 million. So again, how do I model that? How do I project that? I don't have a way to predict whether or not they will lump differences within their purchases and proceeds from their treasury securities. But my opinion in general is that they are tightening their windows. I think some of their T-bills that expired in 2024 were 1 year or even 3 year bills. And I think the funds that they've invested, the T-bills that they've bought in 2024 or in 2025, I think they are shortening the time window. I don't think they're committing any funds to long-term securities or bills. I think they are putting it in 1 month bills primarily and some 3 month bills to stay as liquid as possible, to keep this cash as deployable as possible. So hypothetically, what would you see? Long term, you would expect to see the difference between the purchases and the proceeds level out, right? You wouldn't expect to see huge differences in or lumps either way, except maybe in Q1s, you still see them go ahead and wait to redeploy money. All that to say, 94444 for cash and securities is what I'm putting it at. Love to hear in the comments your thoughts, differences. As far as total assets, then you basically sum these three, and you've got a $500 million bump in total assets. Um, Book value as a result. If you value the convertibles as debt, their stockholders' equity bumps by $250 million quarter over quarter. Huge, huge improvements. And if you consider the convertibles as dilution, again, you still see that $250 million bump. Their book value going up to 9.57 billion. Insane type of quarter, type of numbers that we're looking at. And Q4 is just going to be that much more insane. Let's finish this up by talking about this clue. So what is this chart? Okay, credit to this guy. 9829 is B09E8737. Okay, this is his graph of GameStop's card inventory. So what he does, he said right here, he goes to GameStop's graded card marketplace. He scrolls down to the bottom and he looks at how many cards total are available for sale on GameStop's marketplace. So I shared in my most recent video, I don't think that their current assets are going to be highly inflated by their new collectibles business. I think they will still stay in a similar range. And look at what happened here. That's super interesting. In October 19th, their inventory plummets, right? They sold hypothetically 6,600 cards in a single day on 10/19. When did they release their physical power packs? Because what I'm wondering is basically there's no way statistically that they sold 6,600 cards randomly in a day. To me, they either moved these cards from their graded card marketplace inventory, they either moved them into the digital power packs ecosystem, or they moved them into physical power packs. And we know they did a physical power packs event. I think the physical power packs event was either right before or right after 10/19. Let's see. No, take me to GameStop's page. When was it? Not the pool party, not online. Okay, we're still in November. Take me to October. Power packs. Oh yeah, there's the whole Halo Wars thing. Power packs are back on October 17th. Look at that. On October 17th, GameStop tweets, Power packs replenish in stores tomorrow, which was an event that happened on the 18th. And then what this chart is saying, he's saying that on the 19th, 6,600 cards left their inventory. That is super interesting because it would be so easy to say that they just clear their inventory every so often, dump them into physical power packs, and then boom, kind of reset. But there's basically no way that that could happen if they're if they're boxing these power packs on the 17th and selling them on the 18th, they would not simultaneously also still have them listed for sale on the 18th online, right? Unless they just happen to have duplicates of everything, which I guess is possible. Oh, let's go, Nico Collins. That's an awesome card. A lot of his rookie cards do not have number 12. because he changed his number to that during training camp or something. Anyways, which is what his number is now. Go Texans. Let's go. It still seems like surely this is related to their physical power packs. I wonder if this event is also right by their next most recent physical power packs, somewhere around what, August 5th or so? Is that when their last physical power packs event happened? Take me to August. Where is it? Not free Pikachu. Where? Okay, there's digital. Where is their most recent power packs? Oh, there it is, July 7th. This is the most recent one they did, July 12th. And on this chart, that does not seem to impact this date. So I don't think these drops are related to GameStop dumping these cards into physical power packs. But look what these drops do land on. Basically right on around August 1st, which guess what GameStop's quarter two is? It ends, it ended on August 2nd. August 2nd was the end of quarter two. August 2nd, 2025. And that dump in inventory happened right there. Right there. And then what's their quarter two? It is September, or sorry, August, September, October, and ended on November 1st. So right here, right around here is August 2nd. Right around here, right, November 1st. Basically, is it, and okay, if we were to go to Q1, when does Q1 end? May 2nd. Check that out. Right at this, what do you call that? 3,500 cards to, upwards of maybe 3,750, 4,000 cards is right where they landed in terms of how many cards did they have available in their online marketplace. At the end of Q1, they had this number right around 4,000. At the end of Q2, boom, crash, right? They didn't sell all these cards. Most likely they dumped these into their digital power packs, and they just so happened to finish the quarter right around that 4,000 card figure. And then again, during Q3, you see they're accumulating, and then boom, dump right around that 4,000 number right at the end of Q3. Two huge takeaways here. Well, really, I mean, maybe three. I don't know. One is, I think GameStop is accounting for their digital power pack inventory somewhat differently. And basically, they can shift whatever they hold in their stores, on their online store for their graded car marketplace. They can shift over into their digital power packs, and they're doing so right on the quarter ends to maintain a very similar level of inventory to keep this balance sheet looking nice and clean. So that's one thing. Another huge takeaway is they are able to accumulate cards pretty quickly, right? This guy is saying, hey, they've been adding 400 cards per day, but look where this chart ends. Okay, this is apparently a 400 card per day rate, and it ended on November 3rd at about 8,000 cards. Eight or maybe 7,600, right around there, or added 7,600 to get a total of 8,000. Look where they are today, 1 week later, 13,000 cards. Wait, this wasn't, he posted this 3 days ago. 3 days ago, they were at 8,000 on November 9th or so. 3 days ago, they were at 8,000. Today, they are at 13,000. So right after it's like, hey, they're adding 400 cards per day. Oh, actually, I mean they're adding 2,000 cards per day, right? GameStop's ability to source graded cards is really something. And that's important. That's awesome. That's encouraging when your CEO has said, hey, that we are able to sell any cards we can get our hands on. And the problem is inventory. The problem is we can't get enough cards. It's easy to read into that as a consumer and be like, oh, they can't get cards. Like, how meaningful is this collectible sales really going to be? And it's like, oh, well, no, they're getting cards. They're getting thousands and thousands and thousands of cards. And apparently, just in the past 3 days, 5,000 cards. Ridiculous. Ridiculous. It's like how are they doing it, right? It's like they're buying cards left and right, anywhere they can find them, they're scooping them up and they're selling them, right? And obviously they can acquire them faster than they can sell them through this marketplace. And we see that because their inventory is growing. And they will try to sell as many of these cards as they can sell through this marketplace. They will, I believe, because they get higher margins here. They're getting 30+% margins here, most likely, if you look at what they offer for trade-in prices, etc. But at this rate of accumulation, there is basically no doubt that GameStop is buying cards at card shows, as some people have speculated. They are not getting 2,000 cards a day traded into their stores. It's not happening that fast. They are also going out and hunting cards. They are buying cards for themselves, and then they'll try to sell them in stores to get a higher margin. But whenever they want to, they can shift these into their digital power packs. And according to Ryan Cohen, once they make that shift, once they dump these into digital power packs, the digital power packs is selling like hotcakes, right? They're blowing up in their digital power pack sales. And then, of course, they also do have their physical power pack events that supplement the digital power pack sales and bring people in store as well. Sell out the same day every time. Super fun, right? But GameStop's buying cards and they're selling cards at scale. Super encouraging on the big picture, on the income side of things, and also super encouraging on the balance sheet side of things that they are maintaining a level of consistency quarter over quarter with where they finish their inventory values, even though, again, they're selling thousands and thousands of cards. Pretty great. If you learn anything in this video, leave me a like. If you have any other thoughts, drop a comment. We'll love for you to join the Halo Sub Club. Okay, 300 something spots left. Hope to cross it this calendar year. That's all I got for y'all on this one. I will see you in the next one.